Good afternoon, everyone. Welcome to Monday Morning Must Knows. My name is Merlin Rothfeld, and here are several things to pay attention to for the upcoming trading week. Now, of course, last week we saw, finally, after months, a break of an unbelievable uptrend in the S&P and the NASDAQ. Finally, breaking a little bit. Does that mean it's going to start to crash from here? No, it just means that the strength is starting to slow down, and maybe some of these events we're going to talk about right now will be the pieces that drive our markets forward this week. So let's start things off with the earnings calendar, as I always do. Now, there's only 63 companies reporting earnings. It's rather boring, but this is a major earnings week. Like, hold on, Ron. How can it be major with only 63 companies? It's not quantity, it's quality. So let's shift over and dive into what that earnings calendar looks like. On Monday, you have absolutely nothing going on. On Tuesday, you've got Tilray and WD-40. Yes, for you all, water displacement version number 40. Curious what that ticker symbol represents there. Wednesday brings us Delta Airlines, and then the fun starts to pick up just a little bit, a wee little bit on Thursday. Constellation Brands, Fastenal, CarMax, and Infosys, and then the real big stuff happening on Friday. Now, of course, every earnings season gets kicked off, and this is officially it. It used to be when Alcoa reported earnings, but that no longer is that relevant. It's all about financials. So let's take a peek at what's going on Friday's session. You start things off with JP Morgan. You have Citibank, Wells Fargo, BlackRock, State Street, and the Progressive. This is a deluge of major financial firms reporting on Friday. Now, this doesn't necessarily mean it's good or bad for the market. It's just we'll start to get a glimpse as to what happened in the first quarter of 2024. And a lot of people are very interested in that, particularly maybe central bankers who are looking at cutting rates going into the 2024 year, and we'll see if they do. All right, let's move on even deeper into what's maybe driving our markets this week, and that is going to be central banks. Now, every week we get different central bank statements, but not often do we get the major announcements with regards to what their rates are going to be. This week, I've got three of them, three major banks making rate statements this week. We start things off with the Bank of New Zealand. That's going to be Tuesday at 10 p.m. Eastern time, so a little bit late for anybody that's trading regular equity market hours, but if you are trading the Forex markets, you know they're pretty much 24 hours a day. Next on our list is going to be the Bank of Canada. They're going to be reporting on Wednesday at 9:45 a.m. Eastern Time. They are expected to stay at 5% as well. So far, no changes from the two banks we're seeing making announcements. The Bank of New Zealand, Bank of Canada, staying right where they are at, which seems to be the norm for countries around the world. And finally, we have the ECB reporting Thursday at 8:45 a.m. Eastern Time. And again, they are expected to stay at 4.5% as they have been for several meeting announcements. Now, this not to say that these are going to be uneventful because they're keeping them the same. Remember, any statement that is made during the press conference after these announcements can cause tremendous volatility. So if you're trading the New Zealand dollar, if you're trading the Canadian dollar or the euro, be ready for some volatility around those times. Maybe go on the defensive here and play things a little bit safer, knowing that you're going to get volatility no matter what is said. And if they deviate from these rate announcements at all and cut or raise, man, you could see some big market moves. Okay. Let's move things back to the most important part, which is inflation numbers. We'll dive into the U.S. markets because, of course, the talk track has been about consumer price index data, CPI, PPI, and the core PCE price index. And that is huge for the U.S. We just saw Jerome Powell at his speech last week at Stanford saying, no, we expect to do some rate cuts by the end of the year. You know, you're going to get some little bumps in inflation along the way. It's no big deal. Well, let's be honest. This is the same guy that said inflation was transient back in, I think, late 2022, early 2023, before we rallied up to almost 10% on inflation. So I don't know if my trust is very high in the statements that come out of Jerome Powell's mouth. He seemed to be going, no, we're okay, everything's fine. Yet I witnessed crude oil rally almost 30% in the last few months. We've seen the bond yields start to surge. Other commodities are rising. I think inflation is coming back, and that may have big impacts on our markets. Of course, CPI and PPI numbers are a major part of that. So let's dive into that CPI number, which comes out Wednesday at 8:30 a.m. Eastern Time. And you can see that the last four readings, we've been seeing higher readings. Now, the expectation is, as you can see on the hard red edge, that it's 0.4. The expectation is that we're going to drop to 0.3 on that month-over-month number. Now, the year over year is the one that I think most people are really interested in, and that will encompass this little red box right here. That shows you the last 11 readings plus the new one that will be coming out on Wednesday. What's noteworthy there, you see that just to the very left of that red box there, you see a small, little tiny blue bar. That one is now being removed from the annual calculation, and that was a low number, which helped things out. Notice that the next bar is a much bigger one. So we're removing a very low reading and replacing it with a much higher one. That is going to cause expectations to jump here. The expectation is that CPI number year over year will jump from 3.2% to 3.5%, something that the market would not want to see, especially for those of you who believe we're getting a lot of rate cuts this year. If inflation continues that trend up, we will not be getting any rate cuts this year. Now, the producer price index, or PPI, which happens Thursday at 8:30 a.m. Eastern time, I put a little red box around that same piece of information. Notice that the left edge of that red box is over a very negative PPI reading. Now, if that gets removed, the probability is better that the year-over-year PPI numbers are going to be significantly higher. What I find ironic, though, is that when they report PPI and CPI, they report CPI in month-over-month and year-over-year. When they report PPI, they only report it month over month. And right now, the expectation is we're going to go from 0.6 to 0.3. Notice the previous reading there on the hard red edge of that PPI chart, 0.6. They think that's going to get cut in half. But keep in mind, that's what they expected last time we had PPI numbers released last month. They thought it was going to be 0.3, came out at 0.6. So my guess is you'll probably see it somewhere in between 0.6 and 0.3. All in all, it does paint a picture that inflation is slowly creeping back up, and this may not be a good thing for our markets going forward, particularly for those of you who believe that we're going to see many rate cuts this year. Don't forget, the markets, as of December 2023, had priced in 8 rate cuts. 8. Well, the Fed said maybe 6. Now all of a sudden the markets are pricing in 3 rate cuts by the end of the year, and if inflation continues to tick up, that number may drop even more to the point we potentially get 0 rate cuts. And of course, the evil thought would be, if inflation continues to rise, do we see rate increases? Only time will tell if that is the case. I can tell you we've got earnings, we've got some inflationary data, and that, my friends, is your Money Morning Must Knows. We'll see you next week.